What is going on, traders? I'm here to do a video you guys always request from me. Well, one, you guys always request trade breakdowns from me, and I'm happy to do those. But two, you guys want to know if you took the same trade with futures and options, the same exact trade, which one gives you a better risk to reward, and what are the differences with using both? So in this video, you're going to learn what is the difference between futures and options. Although I did a full futures tutorial video where I break down part of that video, I break down the difference between futures and options. Check that out here after this video. It's a full, complete tutorial from start to finish on how to trade futures. But you'll also learn which trade is cheaper, which trade gives you the better percentage return, which trade has a better risk to reward ratio, which trade is better for smaller accounts, and hopefully by the end of the video, it will allow you to make a decision as to which utility or derivative vehicle that you want to use. Let's get right into it. All right, so the first part of this video, let's go into the actual trade. Now, I'm using the S&P 500 futures. And by the way, I use the futures chart even if I'm trading other things S&P based, whether they're SPX options or the SPY. I will look at the S&P 500 futures because, fun fact, and we'll go over this when we talk about the difference between options and futures, is that futures trade 23 hours a day, 6 days a week. So the chart is a lot more contiguous and you don't get these gaps that you see with the SPX, right? You see these gaps here because the SPX is a market that closes for a lot longer than the futures market does. So that is why I tend to look at the S&P 500 futures. So I'll start off with the trade breakdown and then I'll get into the nuances between options and futures. And by the way, everything will be tagged in the chapters below, so feel free to skip forward and back as you like. Also, be sure to follow me on Twitter and Instagram. Free trading and finance content daily. I'm always posting free macro analysis as well as plays. I posted ExxonMobil play. I posted a Soxal play, which made 60% on those puts, by the way. And I even give you market updates from a motorcycle on Instagram. So follow me on both of those, good follows, and they're free. Let's get back into this trade. So the trade was basically a short on the S&P 500. And on this day, we kept making higher highs and higher lows. This is the 5-minute chart. One thing I tell people is switch to a line graph if you're having trouble figuring out where market structure is. Now, sometimes market structure is just unreadable, like when you get these flat days like this. But on days like this, where you're making higher highs and higher lows, this helps you determine market structure. So market structure was bullish, obviously making higher highs and higher lows. And I would typically not short a bullish market structure unless, and you guys know this if you're fans of this channel, unless liquidity was taken. Now, how do you know where liquidity is taken? Well, there isn't really a hard and fast rule. Everyone goes by different metrics. For me, I look at things such as order blocks. I look at things such as previous highs. And sometimes you're going to have to zoom out in order to find these things, right? So there's always a question with newer traders of which time frame do I use? Well, use the time frame that you're trying to trade against. So if you're day trading, you want to use smaller time frames, but sometimes you have to confirm things on higher time frames. So in this case, when I saw this high here and I saw this high here, and then we pumped well past it, I'm like, well, where else are we going to go? You have to zoom pretty far back to see other relative highs. Well, this is when I switch to a larger time frame because I want to see what is going on here. I want to see if there are other highs that I should be aware of as the market continues to pump. Well, in this case, we have and this isn't, I guess it depends on what definition you go by, but this isn't a traditional order block, but it is an area of demand, right? This is called a supply zone here. Actually, it's a lot cleaner on the 15-minute, which is what I evidently used. I used the 15-minute here. So this was the order block that I was talking about on the 15-minute. So in this case, on the 15-minute, I spotted this order block. Now, this might not be an order block exactly, depending on which definition you use. But in this case, this was the last green candle before we saw a drop, right? And this is considered an imbalance, depending on who you ask. I read a lot of trading books. I'm a huge fan of Al Brooks. This is one of my favorite books, reading price charts bar by bar. He also wrote a bunch of other books, but he's a legend in Wall Street. This right here is a form of imbalance. And for sure, even if you were just a supply and demand trader, you could see that traditionally, this is an area of supply here, right? This is definitely a supply zone. So whichever metrics you use, you could see that this is an area of interest, right? Which is what you want to know as a day trader. So I'm looking at this and I'm like, okay, it's late in the day. My daily bias is actually bearish, even though we had bullish momentum. And on the daily chart and even on the weekly chart, you have this trend line where the S&P 500 is pinned against. And you see that we have a drop from this trend line. So my daily bias is actually bearish, right? So it would not be so out of the realm of possibility to see a bearish turnaround, especially since this bullish action came really late in the day after lunchtime. So I'm looking now for shorts because, again, I'm not going to short a strong trend, but I'm looking for, areas of interest where there could potentially be some reaction. So now that I marked this area here, I want to see how the price reacts to this, okay? So I'm looking at this and I switched to the 5-minute because I want to see more candles. I want to see more reactions here. So I keep this on and you see these tall wicks into this area. Now, how do you know whether the area of interest that you picked is right? Like if you are testing out your supply and demand skills or your support resistance skills, how do you know whether the area you picked is right? Well, exactly this. You're seeing a major market reaction to it. 1, 2, 3, 4, 5, 6, 7, 8, 9, really 9 or 10 candles on the 5-minute chart. So almost an hour reacting to this level. Now, the way to trade this, there's a couple of different ways. You can easily just, short this the minute that it enters here or wicks in here and set a stop limit above this area of interest. And I'll show you what I targeted and why I targeted it in a second. But basically I targeted VWAP, which is this white line here. So you can either just short it outright, or what prudent traders will do is they will wait for the breakdown and a retracement. I always say that a retracement trade is the easiest way to trade if you are a new trader, and a method that you will take with you as you progress to becoming a more advanced traders. Even advanced traders trade retracement trades, whether they're using Fibonacci's, breakout gaps, fair value gaps, whether they're using moving averages or whatever. A retracement after the move is what a lot of day traders will look at. So what I decided to do was I waited until we actually broke down and went back to retest it, and I shorted it the minute that it actually hit this level again. And my plan was to take a stop limit above this area of interest at 39.45. So I entered at 39.38. This right here, we're talking about futures. I promise I'm going to get into the options section in a bit, but I'm just going over the trade and then I'm going to get into the difference between this trade, taking it with futures and taking it with options. So I entered it with a stop at 39.45. And I targeted VWAP, giving me a risk to reward ratio of over 2, which is amazing, right? I aim for at least a 1-to-1 risk to reward. In this case, I'm getting over 2. Fits all my criteria, entered the trade comfortably. Now I'm going to talk about the reason why I targeted VWAP, and then I'm going to get into the breakdown between futures and options. The reason I targeted VWAP is simply this. This entire day and the previous day, VWAP was a very important point of stickiness, right? You see the price action hovering around VWAP, and then every time it drops below, it retracted to it like a magnet. It snapped back to it. Every time we retracted below, snapped back to it. And then even when we got above it, this was where I was like, okay, VWAP has been a magnet the whole time, so I'm going to target VWAP, which to me was a pretty simple target based on the action that we saw for an entire day previously. Now, let me get into a very quick crash course about the difference between futures and options first, before I dive into what this trade looked like with futures and what this trade looked like with options. And if you're enjoying this video so far and you're getting a lot out of it, please hit that thumbs up and let me know in the comment section, which is your favorite part of the video? What did you learn in the video? I'd love to hear from you guys, and I try to respond to each and every comment. And while I have you here, if you're watching this before January 28th, just know that we have a free mastermind webinar that we are doing. This is our regular mastermind that we do with our Academy members. We're opening this one up to the public so that you get a glimpse of what we talk about. We're going to be going over future strategies, option strategies, technical analysis, all the stuff that you guys love and come to this channel for. So it's completely free. You'll find the link in the pinned comment. Register down below. And if you do register a spot, be sure to show up so that you're not being an asshole and taking up somebody else's spot. And then the recording will be sent out if you register via email to you. So it behooves you to sign up, and you will get the recording of the webinar as well thereafter. All right, y'all, a quick recap of options versus futures, okay? Options. We're going to do pros and cons, okay? Pros about options. Options are generally cheaper. Futures require $1,500 of collateral, and that's for the micro S&P futures. For the minis, which are the ones that all of the big boys and girls trade, it's $15,000 per contract. That's the collateral. So we're going to put pros here and cons here as well. So more expensive. Pros with options can be often higher percentage gain when you're trading, right? And we're talking about percent and not nominal gain. Another thing about options is obviously there are more of them, right? More choices, because you could trade options on Tesla, you could trade options on Apple, not only the S&P 500, you could trade options on literally everything. You can even trade options on futures, which is a crazy mindfuck. That's like that movie Inception. So more choices, right? Now, cons with options. You have what's called theta decay, meaning every day an option becomes less worthless. Yes, even winning ones, right? This is the concept that newbies don't understand, that options are meant to drop in value every single day that they are kept open. The only reason that you might be in a winning position day after day is because delta is working in your favor. That means that the stock is moving towards your position, up if you have a call or down if you have a put. But theta decay, meaning they can easily go to zero if they are out of the money. So cons, theta decay can go to zero. Taxed as short term, right? We'll learn this about futures, is that one of the pros is it takes advantage of what's called a 60-40 split. 60% of it is taxed as long-term, and only 40% of it is taxed as short-term capital gains. So the long-term capital gains rate's usually somewhere in the range of half of what the short-term capital gains is. Pros with futures, 23 hours a day, 6 days a week. Cons with options is it's only Monday through Friday, basically market hours, right? So for those of you that always ask me, oh, I have a full-time job, I can't trade during the day. Well, guess what? You could trade futures at night because they're open 23 hours a day. Pros with futures is there is no theta decay, right? Now, here is where I think I would say that the biggest difference is, right? Is with futures, you have fair value or face value pricing, right? And with options, you have irregular pricing, which is a con. So what I mean by this is that the way that options derive their price is really by the supply and demand for that contract. And obviously it follows something complex like the Black-Scholes model. That's why, you have things such as IV crush and theta decay that really play a big factor in the options price, where you don't have that with futures. With futures, what you have essentially is the price that you see is what you get. It moves up by 5 points, then you get 5 points worth of value. It moves down by 5 points, you lose 5 points worth of value, right? Just like a stock. If you buy Tesla at 120, it goes up to 125, you made $5 per share. If it goes down to 115, you lost $5 per share. There isn't theta decay and implied volatility and all that stuff with futures. So I should put here IV next to theta decay. So that is a crash course. Again, after this, watch my entire video on futures, a tutorial from A to Z. Again, that is going to be linked in the cards. So watch that after this if you still want to learn how to trade futures. So that is a crash course. Now, let us get into this exact trade here. So in this trade, as I said, I shorted it from 39.38. Okay, so we're going to take the future side first. I shorted it from 39.38, wrote it all the way down to 39.2175. So here are the trade updates. I said if we close below this, next stop is VWAP, and I put 39.2175. I said Z is being a dick for a tick. And as you can see here, it finally hit my exit. VWAP hit. Pay yourselves, boys and girls. And this was right at VWAP, 39.2175. So on the future side, here we have 39.38 minus 39.2175, right? This was my entry. This was my exit. So I made 16.25 points. Now with futures, when you go back and watch that video, you'll see with the ES futures, these are the S&P 500 mini futures. Each dollar or each point, you multiply it by 50, and that's how you get the dollar amount that is worth. So in this case, 1625 times 50 is 812.50. I didn't cheat and pause the video and calculate it and come back. Actually, I did. So it's 812.50 per contract. Now I traded 5 contracts, right? So my profit for this was $4,062.50. What did I risk for this? Remember when I said, when I was talking about the collateral? So ES futures, you need 15,000 of collateral for each contract. And this is on TD Ameritrade, same as most brokers in the US. So 15,000 times 5 equals 75,000. Yeah, I did that one in my head. It's 75,000, okay? So it took essentially $75,000 to make this $4,062.50. That is a gain essentially of 5.4%. Now, I know that it might seem that you're risking a lot to make that much. If you look at the implied risk, it's not that much, because if we set our stop limit just at 7 points higher, which was 39.45, you're going to be losing 7 points if your stop limit hits. 7 times 50 is $350 per contract. So you're not actually risking a whole lot, but you do have to have $75,000 in margin collateral, right? And you have to have a margin account, by the way, to be able to trade futures. Now let's look at the options, and we're going to be using SPX options, right? SPX options, by the way, expire every day. So they have 0 DTE or 0 days to expiration options every single day. Now we took the same exact trade with the 3,900 puts, right? And the 3,900 puts, we made 135%, 134% and change on the 3,900 puts. Now that looks amazing on the surface, but here's why it's not, okay? Let's jump into the numbers first, and then I will tell you why there is a huge difference, not only in the number side, but a huge difference in the way that you're going to be managing the risk between SPX options and ES futures, right? There's a huge difference in how you manage the risk. And spoiler alert, when you're trading 0 days to expiration SPX options, risk management goes out the window. It's basically non-existent. And we'll talk about it more after the numbers. So let's talk about the numbers. So I bought these puts around here, as I said. And at the time, those puts were, and here on the right is the chart of the puts, right? And I bought these puts around 65 cents. Not around, they were actually exactly 65 cents. And here you'll see the trade price, 65 cents. So as I said before in my summary of options versus futures, that one of the advantages of options is that they're cheaper. So this only cost me 65 cents, or obviously, as you guys know, if you trade options, $65 per contract, because you have to multiply it by 100. So it cost me $65 per contract. So if I wanted to short, I didn't have to put up $15,000 of collateral for ES futures. I could have, bought one option or 2 options, maybe 10 even for $650. It's really nothing compared to the amount of collateral that you have to put up for futures. And as opposed to that 5.4%, I actually made 135% with these contracts, right? But this is not black and white. This is not a differentiation just between the percentage numbers. Trading the futures allowed me to have a very solid and manageable stop loss. 7 points, that was it. Face value pricing, remember, going from here all the way down, there is no theta decay. There's no IV crush. There's none of that. And this is where I get to the main difference between trading futures and options when day trading, especially 0 days to expiration futures. If you buy options here, even if you're right, if it becomes later in the day and, I bought those 3,900 puts, which 3,900 on the SPX chart is around VWAP, slightly different on the ES chart. But the later in the day becomes, the further away from my target or the strike price itself, those options will eventually go to 0. So even though I bought them here and it took a while for it to play out, as time is going, it's experiencing violent theta decay. And if you look at this option, it went from 65 cents all the way down to 15 cents. Sorry, let me move my head so you can see it. It went all the way down to 15 cents. So this option was actually down 70% at one point. And you see this last spike here is when towards the end of the day, we got to our VWAP level on the S&P 500 and eventually went up to 135%. And you could basically see it hitting VWAP on the last 5-minute candle of the day. Now, I know that I could have picked a higher strike price so that there's more chances in the money, say like the 39.30 strike price, and I wouldn't have had to deal with such a cliff's edge. However, the same problem would still persist where towards the end of the day, if you're not near your strike price, it's going to lose theta decay and very violently. And even if you are right at your strike price, there is not going to be any extrinsic value left in the option because you are at expiration day. So while in this case, I had a very manageable stop loss with the futures, in this case, I really had to suffer through a major downturn before it became profitable towards the end of the day. So when you're trading 0DTE options like this, if you go far out of the money, you basically have to size for zero and accept the fact that most likely your option has a high chance of going to zero, whereas with futures, you don't have to worry about that. And in this case, these contracts went to $1.50 or $150 if you multiply it by 100, so $150 per contract. So obviously for fun, let's see what would happen if you put $75,000, which was the amount of collateral that we put up for those 5 ES futures. This would have lost 70% of value, so down to like 22,500. But by the end of the day, would have netted you 176,000 and change. Now, obviously, you're not going to be putting up the same amount of money for the SPX options as you are for the ES futures, although I don't know, the way I've seen some people trade online, they would. Now let's see what would happen if we actually went with ones that were close to the money. So the 3930s as opposed to the 3900s, which was near the level that we shorted from. We shorted at 3938, remember, even though between ES and SPX is a slight difference, but neither here nor there. These still would have lost about 20% of value, right? You would have paid about $1,200 for them. They did drop to about $1,000, so they would have lost 20% of value, and then eventually closed for $3,000. So you did make a little over 100%. However, this one did cost about $1,200 as compared to the out of the money ones that cost $65, and they did lose 20% in value. Now, if we go to the 3910s, for instance, these were out of the money, but not as out of the money as the 3900s, obviously. And you look at that, these ones were selling for about $200 and change, and they dropped all the way down to $1, even as the S&P was going down before finally closing out at $10 or $1,000. So you 5x'd your money on that, but you still had to suffer a 50% drawdown. So with all these numbers out of the way, here's the moral of the story. With 0 days to expiration options, if you go out of the money, you have to be able to size for zero. You cannot size in the same way that you would, say, a futures trade. You cannot size in the same way that you would other trades. You have to be able to size for zero if your decision is to buy a cheap contract out of the money because you have so much conviction in that trade playing out the same way that we did with that future short or that S&P 500 short. Before making 135%, that option lost 70% of its value. And even if you went closer to the money, you still had to suffer 20 to 50% drawdowns before actually seeing gains in those options. So you have to be able to size for a big loss or size for zero. Now, a caveat to this is the closer to the money you are, or even if you buy at the money SPX options, it's going to be expensive, but that one you can actually manage your risk a little bit because you can actually set a maximum drawdown of, say, 30%. Now, it's still going to be a lot higher than a max drawdown in futures, and you have to have a stomach for it. One other solution is to not play 0 days to expiration and actually go further out in expiry. You can go to one expiring the next day or the day after, but those ones are significantly more expensive depending on which strike price you look at. Could be double, could be even 5 times more. So if you're going to trade options and you do have a care for risk management and max drawdown, you will either want to go at the money or close to the money, and or you will want to further out your expiration by a few days so that you are not getting killed by theta. Even if you plan on closing those the same day, by the way. And if you want to trade comfortably with face value pricing, the same way that you would a stock, for instance, where if it goes up by $5, you made $5 a share and vice versa, then you want to look at futures. Obviously, you're going to need to have some major collateral. Now, the micro futures do only require 1/10 of the collateral that mini futures do. So instead of 15,000, it's 1,500, but the gains are also capped at a multiplier of 10 or a divisor of 10. And if you want access to all of our plays, including this killer play that we made $4,000 on, or 135% on the SPX options, link is in the description. Come join a community of traders where we're talking about this stuff all day, every day, giving live updates on the trades, our analysis, feedback to other members about their trades and their charts. I don't think there's another group that has onboarded newer traders into the world of options and futures more than we have. Our goal is to fast track this stuff for you. So if you want to join, click the link in the description below, book a call with one of our ambassadors. They will get you set up and take care of you. You also get access to 60 plus videos of content, the options course, the day trading course, etc., and the mastermind calls with me where you get to ask me any question you like. If you have any trepidations about joining and want to see what it's all about, join that mastermind for free January 28th at 12 p.m. Eastern. Would love to see you there. Hit that thumbs up if you got anything out of this. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.